Time to see what's on the radar. We're back with Dan Rohinton, portfolio manager at IA Global Asset Management. Dan, you got a couple on the radar. We'll start with, do you want to start with Constellation or Manulife? We got two, so we can...
Yeah, sure.
Constellation?
Let's talk Constellation.
All right, let's talk Constellation. The earnings were out.
Pretty decent quarter for capital deployment. The top line, they did come in a little bit weaker because there is one healthcare division that has been bouncing around in its organic growth. I think it was about -3, went down to -7. That's an improvement from -9 on a trailing basis. But all things considered, it's hurting organic growth, but they paid a decent price for it.
Yeah.
That's really not the main conversation, though, because the quarter was never going to be that good or that bad in all reality. And capital allocation is the big driving bus here. But the reason the stock has been weak over the last several months, frankly, has been around the idea about their capital allocation counting in the future. And what I mean, and the terminal value of the business itself. Because when you have a constellation of, and no pun intended, of very small vertical software businesses that go in all different varieties, from construction all the way to golf courses and so on and so forth. When you cover all these tiny little verticals, where it was an entrepreneur or two who's a computer programmer who said, I'm going to build a software for this specific task, is what's rolled up into this overarching business. But now the walls of software are coming down. And I'll use Sam Altman, the CEO of OpenAI, the builders of ChatGPT, and he talks about the world of fast fashion for software, which is basically if you can dream it, you can build it. That's a bit of a problem if you paid for all of these tiny businesses, and some not so tiny. And is it possible just for small entrepreneurs to just build a competitor to you that's better?
Yeah.
That question was already live for some time because of what was known as SaaS 2.0, so software as a service. All these, of the Workdays, of the ServiceNows, of the NetSuites of the world and the Salesforces, but there was a whole cohort of companies that were underneath that. So it wasn't one entrepreneur or two, it was 6 or 7 that got some venture capital financing and said, let's go take on the golf industry. Let's go take on the construction management and planning industry. That was already happening. This just supercharges that competition. I don't think these questions are going to go away.
How is Constellation responding?
There's only so much you can do. The reality of the situation is they're great capital allocators. That's been proven out through their decade plus of how they've deployed capital. So the question is, can you do anything in your situation? The reality is you can't, because it's a paradigm change. It's a phase shift in the reality of the world. So there's nothing they can do. They could cut costs. Sorry, I'm exaggerating. Let's be specific. Could they cut costs? Sure. Could they be a bit more cagey about what valuations they're going to pay and demand a higher hurdle rate? Absolutely. But they've already got billions of dollars of invested capital that is at risk in terms of what, if you believe this phase shift in how software is done. So can they do things at the margin? Yes. Can they change their business model at its core? No.
So where then? Where do they go? What do they just keep?
You got to do what you got to do. Buy back stock. You can cut costs at the margin. Sometimes. But
eventually you're going to run out, though.
You can keep buying back stock for a while. I'm saying all I can say is there's nothing you can do if there's a phase transition happening.
Yeah.
And the best way to think about it is, let's talk about another company. Let's talk about Meta Platforms. And Zuckerberg gets a lot of flack for a lot of things, but he is by far the best capital allocator, and he's willing to bet the farm on new ideas. So when Facebook was invented on the desktop in a university dorm, then the world changed to mobile. He navigated that, and Meta and Facebook at the time navigated that perfectly. And then came short form, then came photos. They navigated that from just the text newsfeed, if you guys remember from back then. Then came video. Then came short form video. And then came the idea of augmented reality. You have to bet the farm, but the problem with Constellation and the dynamic that they have here is it's the balkanization of software. And they're a consolidated, not monolithic, but a distributed software company. So you can't front run the venture capitalist who's further ahead of you in the life cycle, and you can't front run someone in a room somewhere with an idea. So they're in a box, but that's why when you think about as investors, there's a price for anything, right?
Yeah.
There's a price for Yellow Pages back then, if people still remember. You just have to pay a decent enough discount for it. I think that's what the market is trying to figure out with this conversation. Am I more of a buyer today than a seller? Probably.
Yeah.
And from what we see in the numbers, because it is getting to a cheap valuation. But I think we have to be honest with ourselves and say, when the world has changed, the terminal value perception has changed.
All right, we want to get to Manulife because we only got about a minute left.
Sorry. Yeah.
No, it's all right. It's interesting with Constellation, but let's talk a little bit at Manulife as well. Your thoughts on?
Yeah, Manulife's a simple conversation. All the other life insurers did a good job. This is, relatively speaking, a very benign time. So markets are strong, spreads are reasonably tight. Sometimes that's a good thing, sometimes that's a bad thing. But more than anything, their job this quarter is to just come in and keep a nice quiet quarter and deploy some capital, maybe buy back some stock, maybe raise the dividend. Those types of conversations for Manulife make sense today. The company has fully turned a leaf from where it was 5-6 years ago, let alone a decade ago. So the financial crisis is firmly in the rearview mirror. And we are talking about the core franchise with a decent sized Asia Pacific franchise, which is higher growth, and a foundation in Canada that is robust. And we just don't want surprises.